Okay, hi everyone. Hi. Okay, everything's working. So we're good to go. Yeah. Chat is working, audio's working, screen is working. Everything seems to be good. Okay, let's start everyone. I am actually quite excited for today's topic. Um, when I was doing research to prepare for this topic for you guys, I was like, whoa, I'm actually learning a lot. I thought I already knew about this topic, but I guess I learn more things every time. Okay, so I am very excited to share this topic with you guys. Yeah, hi everyone. Welcome to today's webinar brought to you by Vantage. Today's the 27th of January. We're going to do commodity currencies. This is an interesting topic. It is a good to know kind of topic. It will help you see the markets in a different perspective. Like it definitely helped me when I first learned about this. Okay, so yeah, it's good to know. Okay, you guys know how this works. Before I start with anything, I do need to go through the disclaimer and I do need to stay here for a minute or two later on so that you guys can actually read through the disclaimer. So basically, anything that I share with you guys in this webinar should only be construed as purely educational. Okay, this is not any form of like investment advice, trading advice. This is definitely not a signals group. I'm not telling you to buy or sell anything. I am here to share my insights. I'm sure to share my point of view, my perspective on the markets. You must be wondering who am I to be sharing all of this with you, but I will, for those who are new here, I will let you know who I am in a bit. But basically, please take this as educational. A risk warning trading, Forex and CFDs, especially if you are trading on margin, carries significant risk and should not be done so lightly. Okay. Hi, Cass. Welcome back. Also, can Vantage upload your awesome webinar, Harry Trades So Relevant after last Friday's lateral intervention on JPY? That webinar is gold standard. Thank you so much, Nina. Um, Good question. Where do they upload the videos once it's done? Give me a sec. I'm just gonna ask in Advantage. Quick question. Where are the recordings uploaded to? I know it's recorded. I just don't know what they do with the recording after. Yeah. I'll let you know the answer once they reply. I mean, yeah. Thank you so much, Lina. That means a lot to me. I do spend a lot of time researching. Yeah, so I guess you guys should be good with the disclaimer, right? I will just stay here for another 20 or 30 seconds so you get for those who have not read through the disclaimer and for those who just joined the webinar. Oh, we don't have they don't keep the recordings. Oh my goodness. So why? I'm just discovering now. Okay. Um, from Zoom. We don't have the recording in the app at the moment, but the Zoom, I know Zoom is recorded, right? Where does the recording go when? Okay, we'll just give them a bit of time to answer us. In the meantime, I'm going to continue. I guess you guys should be done with the disclaimer. Okay, yeah, so if you guys are wondering, for those who are new here, who am I to be sharing all this information with you guys? My name is Cassandra. You guys can call me Cass. I am an investment analyst and a prop trader. So I'm with a research firm called Everest Fortune Group based in Singapore. That's why I don't know anything about the Vantage back end because I am basically invited. I'm basically invited by Vantage to do this webinars, this 1 hour educational webinars for you guys on behalf of Everest Fortune Group. Okay, that's why I don't know anything. I don't know where the recording goes. I don't know anything that is back end other than these educational webinars. So when you guys ask me a question, sometimes I don't know the answer to it, especially when it's Vantage related, because I'm not actually with Vantage. I'm just an invited speaker for Vantage. Okay, so but yeah, ask me and I will ask Vantage where you can get whatever it is. Okay, so I am an other than being an investment analyst with Everest Fortune Group, which has been the finalist for the best forex and equity research for multiple years running. I too am a prop trader. For those who don't know what prop trading means, is that I am funded by multiple companies. How did I get this funding? I basically had to pass a few tests. A lot of the tests required me to do 10% profit within a month. So a month is 22 trading days. I've successfully done 10% many, many times. It's actually a normal result for me to do 10% a month. And I don't do that by overtrading. I actually only trade once, twice, sometimes 0 times in a week. I'm actually on the charts very, very little time. So a lot of new beginners, people who are new in trading, they're like over trading, they're like staring at the charts, they have like 10 screens. That's so unnecessary. I trade from one laptop, from TradingView, from my phone, and that's all I need to make the profits. So you don't need to overcomplicate trading. You can be profitable from trading, just simplify it as much as you can. And also, how did I do that 10%? I did a lot of technical analysis. So I would say I specialize in technical analysis. And now that I've started combining fundamental analysis to my overall analysis, I've become even more profitable. So it is good that you guys are here learning about different topics because every time I'm doing this research for you guys to teach you guys to share these topics with you guys, I also learn a lot of new things and I'm just like, whoa, it helps me see the market from a different perspective. So it's good that you guys are here. I know sometimes the topics can be quite boring, but it's very informative and it's good to know. Okay, so if you guys have any questions, anything trading related, ask me in the chat box. I will do my best to answer you. I will do my best to help you. That's the whole point of Vantage bringing these webinars to you guys so that you guys have a place to ask a professional trader. Okay, so agenda for today is to understand Australian dollars, Canadian dollars, New Zealand dollars, the different drivers. I know they're the same labels. China versus the US demand, who matters more? I think we talked about China and the US before. We've talked about it. Just going to be another overview of it. Inflation cycles and commodity forex, and the best environments to trade commodity currencies. Okay, let's start. But first, I do want to adjust my chat box and things so that my notes are not in, it doesn't block my notes. I am referencing some notes because I do a lot of research. I cannot remember everything I research, so I'm just referencing my notes. Okay, so let's start with Australian dollars, Canadian dollars, New Zealand dollars, and the different drivers, but I know they kind of are like the same labels. Okay, so all right, let's begin with the phrase that everybody in Forex hears very early on. Okay, sometimes people hear it so often they stop thinking about what it actually means. The phrase is commodity currency. Okay, I don't know if you guys have heard it, but I definitely have heard it at some point of my trading career. Okay, so people say it, but like it's a neat little box, like Australian dollars, Canadian dollars, New Zealand dollars, the commodity currencies. These are the known commodity currencies. And in a way, yes, it's true, but it's also the kind of truth that can quietly cost you money if you treat it like a rule instead of a starting. Okay, so when we say commodity currency, what we really mean is this: the country's economy is meaningfully shaped by exporting raw materials and raw material linked products. Okay, and those exports influence the country's income, growth, and inflation. And because Forex is like over time, a market that reflects relative growth, relative inflation, and relative interest rates, the currency becomes sensitive to the commodity cycle. So it's not that commodities up equals currency up, okay, in a simple mechanical way, which before I started doing research for you guys, that's what I thought. If commodity is up, the currency that is tied to it also go up. Okay, it's not as simple as that. Okay, so it's like commodity prices and commodity demand become a major input into the country's macro story. And the macro story is what drives Forex. Okay. And that macro story has a few big channels. The first is the trade channel. If you export a lot of something and something's price rises, you can earn more foreign income for the same volume, right? I think that's simple to understand. Okay, so that often improves the trade balance and the current account. In simple terms, it can mean more foreign buyers mean your currency at some point in the chain, or it can mean your country is accumulating more external income. Markets like that. Okay, so the second channel is growth. When export income rises, mining, energy, transport, and related investment can expand, employment can improve, corporate profits rise, growth looks better, and the third channel is inflation. Higher export income and higher commodity prices can fit into domestic inflation directly or indirectly. And then this is the important bit. Central banks may respond, so commodity exposure can end up shaping interest rate expectations, and interest rate expectations are a very powerful drive of Forex. Okay. Now, the reason I'm taking time to say this slowly is because many traders, especially newer traders, treat the word commodity currency like a trading strategy. They think it's a risk on basket. They assume Australian dollars, Canadian dollars, and New Zealand dollars will behave like siblings. If one moves, the other should move. Okay, they assume correlation is permanent. And yes, there are times when the global macro backdrop is so dominant, like a big risk on surge or a global reflation wave, that these currencies can move together, but it's not because the label is magical. It's because during that period, the dominant driver is shared. Okay, this is what I want you to carry in your head, okay, for the rest of the webinar. A label is not a driver. A label is a classification. A driver is a mechanism. And in trading, if you trade the label, you trade a stereotype. But if you trade the mechanism, you're trading reality. You are trading what is actually moving money and changing expectations. So if you go through AUD, CAD, and NZD, I want you to imagine each one has its own economic plumbing. The pipes are connected in different places. The water pressure changes for different reasons. And if you assume all these houses have the same plumbing because they're in the same neighborhood, you're going to turn the tap and be confused when the water doesn't come out the way you expected it to. Okay. And one more point before we move on is people say commodities. When people say commodities, they often say it like it's one thing, but commodities are a universe. Oil is not iron ore. Dairy is not copper. Gold is not coal. Each commodity has its own demand base, supply constraints, and price dynamics. Okay, so the first discipline we want as traders is to stop talking about commodities in general terms and start asking which commodity, whose demand, and what macro transmission into Forex. That's the foundation. Now we can actually talk about why Australian dollars, Canadian dollars, and New Zealand dollars are grouped together, but should not be traded as if they are the same animal. Okay, so now let's do the practical part. If you remember nothing else from the first slide that we went through, remember this: Australian dollars, Canadian dollars and New Zealand dollars are called commodity currencies, but each one is wired to a different kind of commodity. Okay, so I put an example here of iron ore to Australia. Okay, let's start with Australia because it's the easiest example of an economy tied to industrial commodity cycle. Australia's export story is heavily linked to things like coal and iron ore, and more broadly, the industrial supply chain. Okay, when the world is building, when the world is manufacturing, when infrastructure spending is strong, when steel demand is robust, Australia tends to benefit. That makes the Australian dollar very sensitive to the industrial growth cycle. It also means Australia often reacts strongly to signals of global manufacturing, like things like PMIs, construction demand, and more importantly, the health of big industrial consumers. Now, I'm going to keep the language simple, okay, but the idea is deep. Okay, industrial commodities are not people buy more because they feel good. Okay, industrial commodities are more like companies and governments build more when the incentive and funding exist. Okay, so AUD can be highly sensitive to growth expectations, credit conditions, and investment cycles. That's why you often see AUD react not just to commodity prices, but to the whole global growth narrative. If the market starts to believe that global growth is accelerating, Australian dollars can catch a bit. But if the market starts to believe global growth is rolling over, Australian dollars can get hit hard. Now move to Canada. Canada is often treated like it's the same as Australia because both export commodities. But Canada's commodity exposure is heavily concentrated in energy, okay, especially crude oil. And oil is its own beast. Oil is not just a growth story, oil is a supply story, a geopolitical story, an inventory story, an OPEC story, a sales story, and a seasonal demand story. Oil can rise during weak growth if supply is constrained, and oil can fall during strong growth if supply surges or inventory build. So the Canadian story is less about industrial expansion and more about energy balance. And because Canada is geopolitically and economically integrated with the United States in one way or another, the Canadian story also has a strong US demand component. The US is a major buyer of Canadian energy, and the US economic cycle matters a lot for Canada's growth outlook. So Canada sits at its intersection: oil prices, US demand, and Canada's domestic inflation and policy response. If you trade Canadian dollars like its cousin of the Australian dollars without respecting that difference, you get confused at the worst possible time when the market is moving fast. Okay, so the last one I want to talk about is the New Zealand dollars. Obviously, I mean, today we're basically focusing on these three currencies. Okay, the New Zealand dollar is one that really breaks people's mental model because it's not driven by iron ore, it's not driven by oil. New Zealand exports based heavily on agriculture. So you can see all different countries are exporting based on different fields, right? Different sentiments. Okay, so New Zealand is using exporting a lot of dairy. Okay, dairy is a classic example. That means the New Zealand dollars is sensitive to global food pricing, agricultural supplies condition, and demand patterns that look more like consumption than investment. People don't stop eating because PMI dipped, but they do change what they buy. They do respond to income pressure, and food inflation can become politically and economically important. Here's a subtle but powerful point. Agriculture prices are often influenced by weather, um, harvest cycles, supply disruptions, and changing input costs. So New Zealand dollars can be influenced by factors that have nothing to do with global risk appetite or industrial expansion. It can be influenced by dairy auction price trends or a supply shock or shifting demands from importers. So already you can see the problem with the label. Yes, these are all exporters. Yes, commodity cycles matter, but their cycles are different. If you say commodities are bullish, that's not a trade idea. That's like a headline. Okay, the trade idea is oil is tightening, and that changes Canada's growth and inflation outlook relative to the US. Okay, that's one example. Or iron ore demand is weakening, and that pressures the Australians' term of trade. Okay, so don't get confused with the three. They are all specializing in three different things. So as a trader, you can think of each currency like this. If a reflection of how the market is pricing that country's income stream, growth outlook and inflation outlook, and central bank reaction function. The commodities matter because they are the big input into an income stream, but the forex moves comes because markets constantly reprice the macro outcome. That's why it's not enough to say buy Australian dollars because commodities are up. You need to say which commodity is up, and why is it up? Okay. So you cannot just, it's not just one headline. You actually need to understand it as a whole or as individually. You need to understand it individually. Okay, let's move on to let's talk about the trap. Okay, because this is where most people get hurt. The trap is correlation thinking. And I'm not saying correlation is useless. Okay, I personally use a lot of correlation in my own trading. And again, I do consider myself a profitable trader. So correlation is important, but correlation is it is some kind of measurement. It is a form of measurement, so you shouldn't use it too heavily. Okay, it tells you what has tended to happen recently, but correlation is not a law of nature. It's not gravity, and it's definitely not guaranteed. Correlation is what get you when the same driver is pushing multiple markets at the same time. If traders get used to Australian dollars and New Zealand dollars moving together for months, they start to believe it's normal. They start to build habits around it and they start to expect it. Okay. And then one day the driver changes and that expectations become a liability. So let me give you a very real type of situation. Imagine oil rallies sharply because supply is disrupted or inventories are tight. Okay, that's a direct positive for Canadian dollars through income and energy exposure. But at the same time, iron ore prices are weak because construction demand is soft. In that environment, Canadian dollars can be strong, but the Australian dollars can be weak. So the label commodity currencies would tell you they should behave the same way, but the driver tells you they should diverge. Okay, so you need to know the entire story. Okay, so let's move on to China versus US demand and who matters more. They both matter, obviously, but we'll just see which one what to look out for. Okay, so now once that we have accepted that Australian dollars, Canadian dollars, and New Zealand dollars are driven by different commodities, the next logical question becomes whose demand actually matters more? And this is where the conversation almost always turns into a debate between the two giants, which is China and the US. Traders often ask this as a simple question: is China still more important, or is US more important now? But that framing is already slightly off because China and the US don't play the same role in the global commodity system. They are not competing demand engines in the same lane, and they are driving different parts of the machine. China structurally is an investment and infrastructure driven economy. Okay, even as it matures, a very large portion of its commodity demand comes from construction, manufacturing, power generation, and heavy industry. When China builds, it consumes steel, copper, iron ore, coal, and energy at scale. That demand directly feeds into the pricing of industrial commodities that affects the Australian dollars. Okay. The US, by contrast, is far more consumption driven. The economy engine is powered by household services, financial conditions, and consumer spending. The US does. Sorry, guys. Okay, the US consumes a commodity, of course, but the transmission is different. The US matters more through energy consumption, financial conditions, and global liquidity than through raw infrastructure built out. So when traders ask China or the US who matters more, the correct answer is it depends on which currency you're talking about and which country is involved. AUD has historically been far sensitive to China than the US because Australia's export basket lines up with China's industrial demands. Canadian dollars, on the other hand, is deeply influenced by the US because US is Canada's largest trading partner and a major consumer of its energy export. New Zealand dollar sits somewhere in between with exposure to global consumption, but less direct linkage to heavy industrial cycles. So instead of thinking in terms of which country dominates everything, you want to think in terms of demand alignment. Which economy's demand profile best matches the export profile of the currency you're trading? That shift in thinking alone can dramatically clean up your macro framework. So why does China matter so much to the AUD? Okay, we already know in a rough idea is because China buys a lot of iron ore from Australia, right? Uh, let's slow down the talk and talk specifically about this, okay? Because China is often misunderstood in the forex trading. Traders tend to react to China headlines emotionally. China stimulus, China slowdown, China reopening, okay, without always thinking through how the story actually transmit into prices and currencies. China matters enormously. Um, sorry, I see someone. Okay, I see your questions. I'll answer them in a bit. Because it's yeah, I'll answer your question at the end of the webinar so that I can finish the slides. Okay, so when construction um when China's construction sector is expanding, iron ore demand rises, prices tend to rise or at least stay supported. Australia's terms of trade improve, okay, export income flows in and growth looks stronger. Inflation pressures can build, and eventually markets start to think differently about Australians' monetary policy. That's the chain. But notice how long that chain is. It's not instant. It's not headline hits, currency moves forever. It's a process, and the markets are constantly trying to anticipate where China's cycle is heading next. This is why Australian dollars often moves not on current Chinese data, but on expectations of future Chinese demand. Forward-looking indicators matter, construction PMIs matter, credit growth matters, policy stance matters. When China tightens credits to property developers, Australian dollars can weaken even if iron ore prices haven't collapsed yet. Okay, sorry guys. I'm working from home, so there are moments when my daughter comes in and calls mama. So I don't know if you guys heard her calling me mama, so I had to mute myself for a bit. Okay, sorry about that, but yeah, I'll be able to finish the slides. Okay, so while China's growth can affect global oil demand at the margin, it's not the dominant channel for Canadian dollars in the way it is for the Australian dollars. This is why historically Australian dollars has been treated as a kind of China proxy in the forex markets. Mm, When traders want to express a view on Chinese growth without trading Chinese assets directly, they often use the Australian dollars. That relationship isn't perfect, but it changes over time. But structurally, the link is real. Okay. However, there's an important nuance that experienced traders learn the hard way. China today is not the same China it was 10 or 15 years ago. Its growth model is changing. It is less construction heavy at the margin. It is dealing with property sector adjustments, demographics, and debt constraints. Okay, that means the intensity of the China AUD relationship can vary across cycles. Sometimes China matters a lot, sometimes it matters less than traders expect. Okay, so the key lesson here is not always trade Australian dollars on China. The lesson is understand which part of China's economy is moving and whether that part affects Australians' export income. If China is stimulating consumption but not construction, the impact on Australian dollar may be muted. If China is supporting infrastructure, the impact may be such that it's much, much stronger. So again, mechanism is more important than the headline. Okay, so let's talk about the Canadian dollars and why the US often matters than more for the Canadian dollars. Okay. Okay, so it's because the US plays a very different role in the commodity and forex ecosystem. The US is not just a consumer of commodities, it is also the anchor of global financial conditions. And this makes its influence both direct and indirect. For Canadian dollars specifically, the US matters enormously because of trade integration. Canada's economy is tightly linked to the US economy. When the US grows, when US energy demand is strong, when US industry and consumptions are healthy, Canada benefits. Canadian oil and gas exports flow south, income rises and investment follows, and the Canadian tends to perform better. But beyond trade, the US also matters because it sets a tone for global risk sentiment and global interest rates. The US monetary policy is the reference point for the world. Changes in the US rates affect capital flows anyway. So when the US growth is strong and the US rates are rising, the USD can strengthen. But the Canadian dollars doesn't always weaken in the same way other currencies do. Some Canadian dollars Sometimes the Canadian dollars can hold up better because stronger US growth implies stronger demand for Canadian exports. This creates interesting dynamics. There are periods where the strong US growth is actually supportive for Canadian dollars, even if the US dollar is strong. There are periods where tightening US financial conditions hurt risk sentiment broadly, which can weigh on higher beta currencies, including commodity currencies. This is where traders have to be careful. It's tempting to say the US strong equals bad for commodity currencies, but that's actually too simplistic. You have to ask strong in what way? Is the US strong because consumption is booming? Is it strong because financial conditions are tightening, or is it strong because productivity is rising? Each version has a different implication for commodities and forex. So for New Zealand dollars, the US matters less directly through trade, but it still matters through global financial conditions. Tighter US policies can pressure global liquidity, which can weigh on higher yielding currencies. Easier US policy can support carry trades and risk appetite, which can benefit the New Zealand dollars. So the US influence shows up more through rates and risk than through direct commodity demands. So when you compare China and the US, the key insights is this: China primarily influences industrial commodity demands, which is crucial for the Australian dollars. The US primarily influences energy demands, financial conditions, and global rates, which is crucial for the Canadian dollars. Okay, that's why the cycles where China headlines dominate US dollar and cycles where the US data dominates pretty much everything. Okay, that's why as a trader, you need to ask yourself, don't ask yourself who matters more. The real question is which demand engine is dominant for this currency and this phase of the cycle. Okay, so let's move on to inflation cycles and commodity forex. Why commodity sits at the heart of inflation cycles. Now we move into what I would describe as the core engine behind commodity currencies over the medium term, and that engine is inflation. If you understand how inflation cycles work and how commodities sit inside those cycles, a lot of confusing Forex behavior suddenly start to make a lot of sense. Okay, so commodities matters for inflation because they sit very early in the pricing chain. Energy, food, metals, they are not optional inputs, they are foundational. Energy affects transportation, manufacturing, and household bills. Food affects cost of living directly. Okay, industrial metals affect construction and production costs. When these prices move in a sustained way, they don't stay isolated, they ripple through the economy. This is why economists often talk about cost push inflation. When commodity prices rise, companies face higher input costs. Some of those costs are absorbed, but many are passed on to consumers. That's how inflation shows up in the real world, not as an abstract number, but as a higher fuel bill, higher food prices, higher rent, and higher prices for goods. Now, for commodities exporting countries, this creates an interesting dynamic. On one hand, higher commodity prices can improve export income and support growth. On the other hand, those same higher prices can push domestic inflation higher. And once inflation rises, central banks are forced to pay attention. This is why commodity currencies often perform best or worse during major inflation regime shifts. Not because traders suddenly like commodities more, not because inflation changes the entire policy landscape. Okay, so when we talk about inflation cycles, we're really talking about a sequence. Commodity prices move, inflation response, central banks react, interest rate expectations shift, and Forex reprices. Forex doesn't usually move first. Forex moves when the market decides that the inflation shock is persistent enough to change policy. This is why understanding inflation cycles give you a time advantage as a trader. You're not reacting to yesterday's CPI print. You're thinking about whether the inflation environment is changing in a way that forces central bank to behave differently. Okay, so one of the most important lessons in macro trading is this. The same data point can mean very different things depending on the inflation regime you are in. And commodity prices are a perfect example of this. Imagine commodity prices rise. On the surface, that looks bullish for commodity currencies, but the reasons they are rising matters enormously. Are prices rising because demand is strong or growth is accelerating? Or are they rising because supply is constrained, geopolitics are messy, or logistics are broken? In a demand-driven inflation environment, rising commodity prices usually signal economic strength. Growth is strong, employment is improving, and demand is healthy. In that world, central banks are often worried about overheating. They become very hawkish, okay? Interest rates are expected to rise, and commodity currencies can perform very well because both growth and yield expectations are moving in their favor. But in a supply-driven inflation environment, the story is very different. Commodity prices rise not because the economy is strong, but because supply is restricted, energy shortages, weather disruptions, and geopolitical tension. These can push prices higher while actually hurting growth. In that world, central banks face a dilemma. Inflation is high, but growth is fragile. Tightening policy too aggressively risks causing a slowdown or recession. This is where Forex reactions become nuanced and sometimes counterintuitive. In supply-driven inflation regimes, commodity exporters can still benefit from higher export prices, but risk sentiment can deteriorate. Financial conditions can tighten, high beta currencies may struggle even as commodities rise. This is why you sometimes see oil prices up, but Australian dollars and New Zealand dollars not performing particularly well. Let's bring this back to inflation cycles. Inflation cycles are not a one-off event. They have phases, okay? Um, there's an early phase where inflation starts to rise and central bank dismiss it as temporary, okay? There is a middle phase where inflation proves persistent and central banks pivot aggressively. And there is a late phase where policy tightening often starts to bite and growth slows. Commodity currencies tend to perform differently in each phase. In early phase, markets are still optimistic. Commodities rise, inflation rises, but policy hasn't fully reacted yet. Commodity forex often does well in the middle phase. Volatility increases and policy uncertainty rises. Some commodity currencies perform well, others struggle, depending on how exposed they are to growth versus inflation. In the late phase, when tightening slows growth, risk sentiment often deteriorates, and high beta currencies can come under pressure even if commodity prices remain elevated. Okay. This is why commodity forex purely off CPI releases and commodity charts is really, really not enough. Honestly, context is very important. Okay, so how inflation cycles translate into forex performance. Okay, let's tie this together and talk directly about forex performances. Okay, because this is where traders often feel confused. They see inflation rising, commodities rising, but forex behaving inconsistently. Okay, the reason is that Forex is not reacting to inflation itself. Forex is reacting to relative inflation and relative policy response. Currencies move in pairs. There is no such thing as inflation in isolation in Forex. What matters is whether inflation in Australia is rising faster than inflation elsewhere, whether the central bank is more hawkish than its peers, and whether interest rate expectations are shifting in favor of the currency. This is why commodity currencies often perform best during inflation regime transitions. When inflation is rising, the markets are underpricing how persistent it will be. Commodity exporters can surprise to the upside. Their inflations can rise faster, and their central banks can turn more hawkish earlier, and their currencies can reprice sharply. But once inflation is fully recognized and fully priced, the advantage can fade. At that time, the focus shifts from inflation to growth damage. And that's why commodity currencies, especially the more cyclical ones, can struggle. Think about it like in this way, okay? Inflation is a spark. Commodity often light the spark, but Forex moves when the fire spreads into policy expectations. The Forex trends end when the fire starts burning growth instead of momentum. So as a trader, the practical question you should be asking yourself is inflation high? Okay, you shouldn't be asking that. But is inflation still surprising the market? If inflation is high but stable and expected, it's already in the price. If inflation is accelerating or proving more persistent than expected, then that's when forex trends emerge. Okay. And this is why experienced macro traders spends a lot of time thinking about the second order effect. They're not just watching CPI, they're watching wage growth, services inflation, expectations, surveys, and policy language. They're trying to figure out whether the inflation cycle has another leg in it and whether it's about to roll over. So for commodity currencies, this is especially important because they often sit at the intersection of inflation and growth. When inflation is rising because of strong demand, they can outperform. When inflation is rising because shocks that hurt growth, they can become unstable and volatile. Okay, so let's move on to the last part of our webinar, which is the best environments to trade commodity currencies. Yeah, this is important to know actually. Okay, so I think we spent a bit of time talking about drivers, demand, inflations, and policy, it's time to answer the question that traders really care about, even if they don't always phrase it that way. The question is, when does all of this actually come together in a way that makes commodity currencies tradable, trendable, and relatively forgiving? The first environment, and historically the most comfortable one, is a period of broad demand-led global growth. This is the kind of environment where growth expectations are rising, not collapsing. Manufacturing activity is expanding, trade volumes are improving, investment is happening, and most importantly, commodity demand is rising because the world is actually doing more, not because something is broken. In this environment, commodity prices tend to rise in a way that feels healthy rather than stressed. Iron ore rises because construction demand improves, oil rises because transportation and industrial activity pick up. Agricultural prices rise gradually as consumption increases, and because the price increases are all tied to real demand, markets are generally comfortable extrapolating them forward. This is when commodity currencies tend to perform best, not because traders suddenly become optimistic, but because the macro math is lining up. Income improves, growth forecasts are revised higher, and inflation pressures build gradually rather than explosively. And central banks are often either still accommodative or still beginning to shift tone. These are the environments where Australian dollars, Canadian dollars, and the New Zealand dollars can trend, sometimes for months, with relatively shallow pullback. Correlations across risk assets tend to be more stable. Volatility exists, but it feels orderly. And for traders, this is when trading commodity currencies feels intuitive because the story is coherent. But here's something important to say out loud. These environments are not the norm. They are phases, they come and go, and many traders build their entire mental model of commodity currencies based on what happens during these good times. Okay. Then when the environment changes, they feel like the market has become irrational. It hasn't become irrational. The environment has changed. So the first best environment to trade commodity currencies is when growth is the driver. Commodities are responding to that growth, and policy has yet become restrictive enough to choke it off. Okay. The second environment is more challenging, more comfortable, and more uncomfortable, and much more revealing in terms of trading skills. This is the transition phase, okay, where inflation has become too large to ignore and central banks begin shifting from support to restraint. This is the phase where commodity currencies stop behaving politely. In this environment, commodities may still be elevated or even rising. Okay, but the market's focus begin to shift. The question is no longer is growth improving? The question becomes, how much tightening will this inflation force and how much damage will that tightening cause? This is where things start to diverge. Some commodity currencies may still perform well if their inflation outlook forces a more aggressive central bank response than peers. Others may struggle because their growth outlook deteriorates faster. Correlations that traders relied on in the earlier phase start to break down. This is also where traders who only understand directions get frustrated. Price action becomes choppier, pullbacks are deeper, headlines feel contradictory. One day commodities are up, the next day Forex is down. And from the outside, it can look very chaotic, but it's not chaotic, it's conditional. In this transitional environment, commodity forex becomes extremely sensitive to expectations, not just levels. It's not enough that inflation is high. It has to be surprising. Okay, it's not enough that central banks are hawkish. They have to be more hawkish than expected. And it's not enough that commodities are expensive. The markets have to believe that high prices will persist without destroying demand. This is where experience matters because the best trades in these environments often come from relative views rather than absolute ones. One commodity currency may outperform another because its inflation is stickier, or its policy response is cleaner, or its growth is more resilient, and traders who are willing to slow down, compare narratives, and accept volatility can still find opportunity. But this is not an environment for simple rules, right? Like risk on by USD. Oh, sorry, risk on by AUD. This is an environment where you need to know why you're in the trade and what would tell you that the environment has changed again. Okay, so finally, we're going to go to our last part. We need to talk about the environment that traders like to focus on the least, but which appears more often than many people want to admit. This is the late cycle of post-tightening environment, okay, where inflation is still present, but growth is slowing, liquidity is tightening, and financial conditions are restricted. This is the environment where commodity currencies become difficult, unstable, and often unforgiving. In this phase, central banks have already tightened, interest rates are high, and credit is expensive. Growth momentum is fading, and markets are no longer debating whether inflation is real. They are debating how much damage has already been done. Commodity prices may still be elevated, okay, especially if supply constraints exist, but demand is no longer accelerating. In some cases, it's actively slowing, and this creates a very uncomfortable mix, high prices without growth. Okay, so for commodity exporters, this can be very dangerous. Export incomes may remain high in nominal terms, but domestic growth can slow sharply. Inflations can remain uh, sticky even as activity weakens. Central banks may be reluctant to ease because inflation is still above target. And even though growth is deteriorating, the forex markets don't like that kind of tension. This is often when commodity currencies underperform broader expectations. Volatility increases, trend falls, rallies fade quickly, and carry trades become vulnerable to sudden risk-off moves. Traders who are used to buying the dip in the Australian dollars and New Zealand dollars find that the dips keep dipping. In this environment, the best trade is often to not trade at all, to be honest, or trading very selectively with clear awareness that the macro backdrop is hostile. This is where patience become a skill, not a personality trait. And this brings us to the most important lesson of this entire 1 hour webinar. Commodity currencies are not something you trade all the time. They are something you trade when the environment is right, when growth, inflation, and policy are aligned in a way that creates momentum rather than contradiction. So if I had to summarize everything we've discussed today in one sentence, it would be this, okay? Commodity currencies reward traders who respect cycles, not just commodity cycles, but growth cycles, inflation cycles, and policy cycles, okay? So when those cycles align, trading feels very easy. It almost feels like it's a trick, okay? When they don't, trading feels confusing, very painful. You're going to be losing money. And the difference between professionals and frustrated traders is not intelligence, it is patience and context. And that's how you should think about when the best environment to trade commodity currencies, not as a permanent opportunity, but as a recurring phase in a much larger macro rhythm. Okay, that's all I have for you guys today. I do see one question here. If you guys have other questions, throw it in the chat box right now. But in the meantime, let me just let you guys know to follow Vantage on Facebook, Instagram, X, LinkedIn, and Telegram. You can get updates on these social media platforms, and these are their handles. Okay, so I see one question here. So should we just trade the Australian dollar as a proxy of China then? Okay, that's a very common way people think about it. It is understandable, and I would be careful with that word, like just, okay? The Australian dollars has often been used as the market, as the proxy for China, like I did say earlier on, especially during periods when the Chinese growth and construction demand were clearly dominant drivers of global industrial commodities. Okay, in those environments, the relationship can feel very strong and very intuitive. However, okay, we need to remember there's always a however. The problem is The problem with treating the Australian dollar purely as a China proxy is that it can blind you to changes in the underlying relationship. Okay, China's economy evolves, Australia's economy evolves as well, and the global conditions also evolves. There are periods where China matters enormously for the Australian dollars, and there are periods where domestic Australian factors, global risk sentiment, or interest rates differentials matters more. So I wouldn't say trade the Australian dollar as China. I would say understand when China is the dominant marginal driver for Australian export income and growth expectation. And when that's the case, the Australian dollar will often reflect China uh, related developments quite clearly. When it's not, forcing that narrative can really lead you into pure poor trades that will eventually lose you a lot of money. Okay. So the key is flexibility. It's not attachment to a single story. Do you know, guys, I always have this rule. If that I am personally doing something, I'm doing one thing, right? And it's been working for long and suddenly one day it stopped working, I will tell myself, okay, I need to stop doing what I'm doing because obviously it's not working. Okay, obviously context matters. There must be something that's happening at this current point of time that is not working. There must be some kind of like macro or micro economic thing that I'm missing. So I should stop trading entirely. So no, Australia is not a pure proxy for China. It is a proxy for China depending on conditions. Okay, so that's all I have for you guys today. I don't really see any other questions. I see the Vantage chat going crazy. I would not be able to answer you guys because the chat keeps moving. It's crazy. There is 11,000 of you on Vantage app. Okay, I don't know where you guys are from, but there's a lot of you tuning in today. So yeah, uh, take care, everyone. I will see you guys in a week. Next week, we've got another interesting topic. I'll catch you guys then, okay? Thanks for joining. Sorry, Nina. Sorry, Nina, they don't actually post the recording anywhere. So I would say these are live, and I hope you guys are taking notes because they're not really sharing the recordings. Okay, but yeah, thanks for joining my webinar, and I will see you guys next week. Sorry, I can't share the recording with you. Vantage just um replied saying they don't have the recording at the moment. Okay, so take care, guys. Bye. See you guys in a week. Another interesting topic. Bye.